welcome to the Deep Dive. Today we are opening up the pantry, but we're not just looking for comfort food. We are cracking open the balance sheet of a company that, well, it touches nearly every American kitchen, the J.M. Smucker Company, ticker SJM. For many of us, this company just represents stability. You know, Jif, Smucker's Jelly, Folgers Coffee, icons.
Right, the classics.
But this deep dive, it's not really a nostalgic trip. It's more like a high-stakes investigation into one of the most, I'd say, aggressive corporate transformations in the consumer packaged goods world today.
Definitely aggressive.
We're watching an icon place a massive, multi-billion-dollar bet on its future.
Exactly. And that bet, well, it completely defines our mission today, doesn't it? We are here to analyze what SJM's recent strategic pivot truly means for their long-term health. Over the last 2 years, they have been reshaping their portfolio pretty dramatically.
Yeah.
Moving away from slower growth, maybe lower margin assets, and charging directly into categories they see as higher growth, namely premium coffee, convenient snacks, and the big one, the debt-financed $5.6 billion acquisition of Hostess Brands.
And that right there, that's the central tension we really need to dissect for you. You have this rock-solid, durable foundation, those iconic brands creating these huge competitive moats. That's the safety net.
A very strong safety net.
But stacked right on top of that, enviable stability is significant execution risk.
Yeah.
A lot of risk.
Huge risk.
They are now carrying enormous debt from the Hostess deal, and they are simultaneously navigating severe, acute commodity volatility, specifically in green coffee, which is their largest segment.
Yeah, that coffee piece is critical.
It is the definition of a show-me story for management. You know, the market has given them the chance. Now they absolutely have to perform.
It absolutely is a performance review in real time, and the complexity is just huge. So over the course of this deep dive, we are going to unpack the completely reorganized segment structure, try to understand where their future revenue is actually supposed to come from. We will gauge the strength of their competitive moats, which are, significant.
Very significant.
We have to analyze the immense, almost crushing pressure they face from persistent inflation and the relentless rise of private label brands.
The private label threat is real.
It really is. And perhaps most critically, we are going to dive deep into the financial statements to dissect a fascinating divergence. Why SJM is reporting these massive accounting losses while simultaneously generating robust, pretty impressive underlying cash flow. That contradiction, it's key to understanding the company's true value.
That distinction between paper losses and actual cash flow, yeah, that's often what separates the informed investor from, the headline reader. Okay, let's unpack this transformation piece by piece. Let's begin with the aggressive 2-year period of portfolio reshaping. SJM basically performed like corporate surgery, excising everything that didn't fit the future growth profile.
Yeah, it really felt like that.
It felt like they were spring cleaning every dusty corner of the center store, What exactly did they ditch to fund this pivot, and what was the common strategic thread connecting these divestitures?
They were surgical, you're right. Their goal was clearly to exit any business that was too commoditized, where pricing power was limited, or maybe where they just lacked dominant market share.
Right.
Think of the things they sold off. They ditched the Crisco cooking oil business.
A classic commodity.
Exactly. Cooking oils are generally a commodity business where price, not brand, usually dictates the purchase. They walked away from a huge chunk of the pet food segment, too, which had become incredibly saturated.
Right, that was surprising.
It was. This included shedding the premium brand Natural Balance, as well as those high-volume mainstream favorites like Rachel Ray Nutrish, 9 Lives, and Kibbles and Bits.
Wow, big names.
Big names. They also shed some slower growth regional assets, like their Canadian condiment portfolio.
Yeah, that pet food exit is significant, though. I mean, pet food has been a huge growth area for years, but it's also highly fragmented and really competitive. So they just decided to pull back from the main dog and cat food aisles.
Precisely. The common thread here is a clear, pretty decisive move to simplify the operating model, raise the overall average margin profile of the remaining business.
Makes sense.
And concentrate managerial resources and capital only where they already possess true dominant market share or, and this is key, where they perceive massive untapped growth potential, which is the Hostess piece, of course.
Okay, now that the house is relatively clean, tell us how the new J.M. Smucker Company is structured. It's not the monolithic entity it once was. It's organized into 5 clearly defined reportable segments now, right?
That's right. These 5 segments are basically the roadmap for their future revenue. And understanding their approximate contribution is vital for assessing where the future growth risk and opportunity really lie.
Let's start with the anchor, still the largest single segment.
That's U.S. retail coffee. This is the enduring behemoth, contributing a substantial, let's say, 34 to 39% of total company revenue.
Still huge.
Yeah. This segment is anchored by Folgers, which is the reliable cash cow, the licensed Dunkin' retail brand, and their major critical growth driver in coffee, Café Bustelo.
Okay, moving on to the sticky signature Smucker's core.
That's the U.S. retail frozen handheld and spreads segment. It contributes about 23% of revenue. This is arguably the strategic heart of the company. It houses the twin pillars of Jif peanut butter and Smucker's fruit spreads, alongside the current absolute powerhouse growth engine, Uncrustables frozen sandwiches.
Uncrustables, we'll get back to those. And the small, refocused pet operation.
That's the U.S. retail pet food segment, now slimmed down to about 17% of revenue. Post-divestiture, it is refocused entirely on high-margin pet snacks, where they are a market leader.
Like Milk-Bone.
Exactly, led by Milk-Bone and Pupperoni, plus their core dry cat food offering, Meow Mix. It's a much more defensible, probably more profitable sliver of the old pet business.
Okay, now the new kid on the block, the segment that fundamentally justifies that massive debt load.
That's the sweet baked snacks segment. It clocks in immediately at a significant 12% of total revenue.
Just from Hostess.
This is entirely the Hostess portfolio, the enormous $5.6 billion acquisition, bringing classics like Twinkies, cupcakes, and Ding Dongs into the fold.
And the final piece, the supporting global network.
International and away from home, which rounds out the rest, about 14% of revenue. This segment handles sales outside U.S. grocery channels, so think food service sales to schools and universities, plus their strong Canadian presence where their existing brands are popular.
So stepping back, the Hostess acquisition is clearly the single biggest move SJM has made in recent history. It changed the structure completely. What is the strategic rationale for spending $5.6 billion to pivot towards sweet-baked snacks? Why this specific category?
Well, it signals a very clear and frankly dramatic pivot toward the impulse snacking aisle.
Impulse.
Right. Management's thesis, their bet, is that snacking is a category with inherently higher secular growth potential than traditional, maybe recession-resistant, but ultimately slow-moving center store staples. Things like canned foods or cooking oil, which they just sold.
Okay.
They are trading the perceived safety of those staples for the potential upside and, they hope, higher margins of convenience and impulse snacking. Sweet-baked snacks have strong brand loyalty, Twinkies, and often drive foot traffic and impulse purchases, especially in convenience channels.
Convenience stores.
Exactly, and that aligns perfectly with SJM's existing strengths in distribution.
So they're essentially acknowledging that the future of grocery consumption isn't necessarily in the bulk staples aisle anymore, but maybe in the convenience grab-and-go section. They are betting that the consumer, even a price-sensitive consumer, will still grab that Twinkie or that Uncrustable when they are rushed or looking for a treat.
That's right. It is a calculated risk, definitely, to buy higher revenue growth in a category where traditionally brand identity and convenience are often more important than pure price comparison, which is exactly where their old commoditized assets were failing.
Right.
They need volume growth desperately, and they are buying the promise of volume growth through snacking.
Okay, when we talk about stability and safety nets, we absolutely must address SJM's most formidable competitive advantage. Its portfolio of iconic brands. These aren't just well-known names. These brands are like entrenched in the consumer mindset. They're market dominators, and the scale of that dominance creates what the analyst community calls a significant competitive moat.
A wide moat, yeah.
Let's look at the numbers because they genuinely redefine market leadership. It's kind of staggering.
They really do. These figures illustrate why the core of SJM is so resilient even when facing macroeconomic pressure. Take peanut butter, the classic example.
Yeah.
The Jif brand alone captures between 32% and 39% of the U.S. market share.
32 to 39%. Just Jif.
Just Jif. And when you factor in their secondary brands, SJM's total peanut butter share approaches a near monopolistic 46%.
Wow, 46%.
That level of dominance is almost unheard of in modern CPG.
And the food spreads are right behind it, aren't they?
Absolutely. The Smucker's brand holds a commanding 45% share of the U.S. fruit spreads market.
45% for jelly. Amazing.
Then you look at their largest segment, the U.S. at-home coffee market. SJM is the category leader there, too, with approximately 26% of the category anchored by Folgers and Dunkin'.
Still number one in coffee.
Still number one. Even in the much smaller, refocused pet segment, Milk-Bone leads its category of dog snacks with a 21% dollar share.
So what does that kind of overwhelming market leadership actually translate to in the day-to-day business? I mean, how does a 45% share of jelly help them in a recession, for example?
That market share translates directly into something immensely valuable: leverage with retailers.
Ah, shelf space.
Exactly. When you are the absolute category leader, retailers, whether it's Kroger, Walmart, or regional chains, they have to give you prime shelf space and robust distribution. You are essential to their customer traffic. SJM boasts a phenomenal 95% penetration rate across U.S. grocery stores.
95%.
That extensive, reliable distribution network is a formidable barrier to entry for any potential competitor, whether it's a startup or an expanded private label offering. They own the shelf, essentially, and that guarantees consistent volume flow.
That shelf space is like guaranteed real estate, isn't it? Competitors have to pay a fortune or offer huge discounts just to even get next to them.
Exactly. It solidifies brand equity and allows them to maintain premium pricing, even when costs rise, which is absolutely critical in this inflationary environment we're in.
Okay. Beyond the foundational dominance, we need to focus on the organic growth engines. These are the brands actually delivering that double-digit momentum internally, validating SJM's investment strategy even before we factor in the Hostess integration. Number one has to be the, frankly, surprising success story of Uncrustables.
Uncrustables is the standout star, no question. And it is the blueprint, really, for how SJM wants to grow. It has consistently delivered strong double-digit growth year after year.
What are the projections?
Management is projecting it will hit $800 million in fiscal 2024 net sales, and the bold target is to surpass $1 billion in annual net sales by the end of fiscal 2026.
$1 billion for frozen sandwiches.
$1 billion, and this isn't just organic growth, it's explosive organic growth driven purely by convenience.
And they are backing that growth projection with immense capital commitment, right?
Yeah.
It's not just optimism, they are building the infrastructure for it.
Oh, yeah, they are putting their money where their mouth is. To meet this surging demand, they are currently constructing a third large-scale manufacturing facility in Alabama.
Third factory.
That is a multi-hundred-million-dollar commitment.
Yep.
And the distribution push is just as aggressive. They are not just sitting in the frozen food aisle anymore. They are expanding into new high-impulse channels, like convenience stores.
Back to convenience.
Yes, exactly. Where they've already secured commitments for product placement in over 30,000 locations. This is SJM leveraging convenience, convenience, convenience.
Okay, moving to the coffee segment. Where is the growth coming from when Folgers is, let's be honest, a mature brand primarily serving an older demographic? It's reliable, but not exactly high growth.
The growth engine in coffee is entirely Café Bustelo. This brand has been delivering double-digit annual net sales growth over the past 5 years.
Double digits for 5 years.
Yes. And it's projected to reach $400 million in annual sales within 3 years.
That's a huge transformation for SJM's coffee identity. Who is the driving force behind that Café Bustelo success? Is it just taste?
It's a combination of taste, authenticity, and demographics. Its success is intrinsically linked to appealing to a diverse younger consumer base, particularly Gen Z and millennials who seem to prioritize flavor complexity and cultural authenticity. It started as a strong regional Hispanic brand, but is now strategically expanding its geographic reach to become a national brand, using SJM's immense distribution network. It provides that essential trade-up option in the coffee aisle that competes against the premium brands, giving SJM a hedge against the inevitable, gradual slowdown of Folgers.
So Uncrustables and Café Bustelo are the proof points that the strategic pivot toward convenience and premium growth can actually work internally. That's a crucial piece of positive momentum they carry into this new era of high debt.
Absolutely. They desperately need those growth drivers to be successful because, as we are about to discuss next, the headwinds they face are quite severe. Now, let's pivot sharply from internal strengths to the significant external headwinds facing SJM and, frankly, the broader consumer packaged goods industry.
Right.
SJM may have great brands, but no brand, no matter how iconic, can completely outrun a really challenging macroeconomic environment.
The overwhelming challenge right now is simply the inflation-weary consumer. I mean, their wallets have just been squeezed relentlessly for years now.
Precisely. The data is pretty sobering. Grocery prices overall are approximately 30% higher than they were back in 2019.
30% higher.
Yeah. This persistent cumulative inflation has fundamentally altered purchasing behavior, making the consumer acutely focused on value.
The sources gave us a shock statistic about the primary purchasing driver, suggesting it's no longer just about enjoying the product anymore.
That's right. Price has officially surpassed taste as the primary factor in purchasing decisions for a vast majority of consumers.
Wow.
A major survey found that 79% of respondents ranked price as a top three consideration when buying food, compared to only 58% ranking taste as highly. This is a huge game changer for CPG giants.
Yeah, it has to be.
When price is the top priority, volume suffers massively. In 2024, an estimated 75% of CPG sales growth was due purely to price hikes, SJM charging more for a jar of Jif,
Right.
with only 25% coming from actual volume gains, people buying more units. That is just not sustainable long term. You can't indefinitely rely only on pricing.
This means SGM is constantly playing this delicate game of chicken.
Yeah.
Raise prices to protect margins, but risk losing volume and potentially long-term customers.
Exactly. And the direct consequence of this value-seeking behavior is the relentless growth of the private label market. The store brands, Kirkland or Great Value.
How significant is that threat, really?
It's massive. Over 50% of global consumers report buying more private label products now than they did just a year ago.
50%.
And the private label market is currently growing at a robust 5.8% compound annual growth rate, or CAGR. This is a direct, almost existential threat to national brands, especially SJM's mid-tier products. Things like their basic food spreads or the standard Folgers blend.
I remember you calling this the hollowing out of the middle market before. Could you explain that concept again for us?
Yeah, it's a great visual, I think. Picture the market as a bell curve, right?
Yeah.
Inflation is basically destroying the middle. Consumers are being forced to make a kind of binary decision. They are either trading down to the cheaper private labels for basic undifferentiated staples like standard peanut butter or simple jelly, or they're trading up to premium differentiated products, things like Uncrustables that offer unique convenience, or Café Bustelo that offers a unique flavor experience. The mid-tier brands, the ones that are neither the cheapest nor the most premium, those are the ones that get squeezed and lose volume. Even within SJM's own portfolio, that pressure is persistent and really intense.
So SJM is facing volume pressure pretty much everywhere, but their largest segment, coffee, is facing an acute near-term crisis, specifically due to commodity risk. Let's talk about the green coffee shock.
Yeah, this is a unique and significant risk for SJM. They are heavily exposed to the commodity costs of green coffee, which has experienced record high inflation. This is due to weather patterns, global supply chain issues, a whole mix of things.
And because coffee is so big for them.
Exactly. Because coffee accounts for nearly 40% of their revenue, these spiking costs directly impact their overall profitability and margins far more than they would a more diversified peer company.
And how is management addressing that specific acute cost pressure? We saw the numbers for their expected outcome, and they weren't pretty.
Well, they really have no choice but to pass those costs directly onto the consumer through aggressive pricing. They've projected a 20% net pricing increase in the coffee segment for the current fiscal year, FY26.
20% price hike on coffee.
20%. And the painful but necessary admission in their outlook is that this 20% price increase will likely result in an estimated 10% decline in volume.
Wow. That's a perfect illustration of demand elasticity in action, isn't it?
It absolutely is. They need the 20% price hike to protect the gross margin dollar figure, but they know empirically that 10% of their volume, and therefore, 10% of those customer relationships, will likely walk away, probably to a private label alternative.
Right.
This commodity volatility forces them into a short-term margin protection strategy that directly contradicts their long-term goal of increasing volume and market penetration. It's just a brutal strategic trade-off they have to make.
Okay, now we turn to the financial statements, and this is where the story gets really complicated, requiring us to dive deep into some accounting distinctions. Because if you only look at the headlines about the GAAP losses, the generally accepted accounting principles losses, it looks like the company is failing spectacularly. But that's really a superficial read.
This is the critical juncture, absolutely. We must differentiate between non-cash accounting results and the actual health of the core operational performance. SJM has reported some truly massive GAAP net losses recently. negative $91 million in fiscal 2023, and an enormous headline-grabbing negative $1.23 billion in fiscal 2025.
Negative $1.23 billion in 1 year. That is certainly alarming and would destroy most companies. What is the driver behind this massive loss? Is it just operations collapsing?
No, it is overwhelmingly due to large non-cash impairment charges. Specifically, nearly $1 billion associated with the goodwill and intangible assets of the Hostess Brands acquisition was written down in FY25.
Okay, let's slow down and explain impairment charge and non-cash for the listener, because $1 billion loss sounds terrible, even if it's just on paper.
It is essential to understand, yeah. An impairment charge means that SJM's accountants formally recognize that the asset they bought, in this case, Hostess Brands, was currently not worth what they paid for it on paper. At least not right now, given the initial integration challenges and market conditions. Think of it like this. Imagine we bought a house for $500,000 and we put that value on our personal balance sheet. A year later, we realize the foundation has a massive crack and maybe the neighborhood market has dropped.
Okay.
We might have to write down the value of that house on our books to, say, $400,000. That $100,000 loss is the impairment. It's a formal accounting acknowledgement of diminished value.
But no cash left your wallet that year.
Exactly. But we didn't actually reach into our pocket and pay that $100,000 in cash during that year. It reflects a change in perceived future value.
So it doesn't affect the cash in the bank today, but it definitely shows the Hostess bet hasn't paid off as quickly as they might have hoped.
Exactly. It's a painful admission that the initial integration has been disappointing, maybe tougher than expected, but it is a non-cash event. The real check comes when we look at their core operations through adjusted figures, which strip out these specific, large, unusual items.
And what does that reality check show for their core profitability? Is the underlying business making money?
Yes, the business remains robustly profitable underneath all the accounting noise. Adjusted earnings per share, that's the measure analysts really use to track core business health, was a strong $10.12 in fiscal 2025.
$10 a share, adjusted.
Right. The core business is performing. In fact, taking such a significant non-cash write-down on Hostess early, while painful, is often seen as a kind of conservative accounting move by management. It helps clean up the balance sheet and set more realistic future expectations for the asset.
We can see this divergence play out in the quarter-specific results, too.
Right.
Let's look at the fourth quarter of fiscal 2025. What did the segments tell us about volume versus price?
They showed a consumer highly sensitive to price increases, just as we discussed. For the U.S. retail coffee segment, net sales were up 11% year over year.
Sounds good.
A great number on the surface, but nearly all of that was price-driven. 10 percentage points of that 11% growth came from price realization, with basically flat volume and mix. They are successfully maintaining revenue, but only by charging significantly more.
And what about the crucial growth segment? Frozen handheld and spreads, the one with Uncrustables.
That segment had modest overall net sales growth of just 1%. And here, we really see the internal struggle playing out.
How so?
The good news is the growth was volume-driven, primarily by the continued relentless momentum of Uncrustables. That's still working.
Okay.
The bad news is that the volume strength from Uncrustables was almost entirely offset by a volume decline in Smucker's traditional fruit spreads.
Ah, the trade down.
That is definitive proof that the private label trade down pressure is actively hitting their most traditional, iconic staples. People are choosing cheaper jelly.
Okay. Let's shift to the balance sheet then. They took on an incredible amount of leverage to buy Hostess, and that debt is the major overhang casting a shadow on everything else.
It is the #1 financial risk right now, without a doubt. Post-acquisition, the total net debt stands at $8.09 billion.
$8 billion.
$8 billion. Relative to the company's market capitalization, which sits around $11.6 billion, they are highly leveraged. That debt load demands immediate attention and is exactly why debt reduction is their absolute top capital priority.
But the saving grace, the central tenet of the bullish argument for SJM, is their incredible ability to generate free cash flow.
Right. That is the core strength and the immediate solution, hopefully, to the debt problem. SJM is a powerful cash-generating machine simply because they sell products people buy every week, consistently.
Right.
They reported strong free cash flow, FCF, of $816.6 million in fiscal 2025. And management is guarding for an even higher impressive range between $875 million and $975 million for fiscal 2026. This cash flow is what services the debt and funds growth.
So even with the negative GAAP earnings headlines, analysts are focused on the free cash flow yield as a measure of underlying value. How do we calculate that, and what does it actually tell us?
Right. We calculate the forward FCF yield by comparing that guided FCF, let's take the midpoint, maybe $925 million, to the market capitalization of around $11.6 billion. Based on those figures, the forward FCF yield is approximately 8.4%.
Okay, 8.4%. Why should the listener care that the FCF yield is 8.4%? What does that mean in practical terms?
Because that is a robust high yield. It means that for every dollar the company is worth on the stock market right now, it is generating about 8.4 cents of clean cash flow that management can actually use to pay debt, pay dividends, reinvest.
Okay.
In a low interest rate environment, or even when compared to the average cash flow yield of the S&P 500, that 8.4% is extremely attractive. It suggests there is a solid underlying value proposition here, independent of the non-cash accounting noise. It is that guaranteed cash flow that gives them the runway, the 2 to 3 years they need to execute the Hostess turnaround and systematically pay down that debt. Without that FCF engine, this strategic pivot would be instantly catastrophic. So, if the debt is the most pressing financial variable, the Hostess turnaround is absolutely the most critical operational variable. This is the ultimate show-me moment for management.
Right.
The success of the entire $5.6 billion strategy really hinges on stabilization and growth here, and the initial results have been, well, to put it mildly, disappointing.
Disappointing is maybe a generous term when you consider the massive impairment charge we just discussed. Management has publicly stated, quite bluntly, they are not satisfied with the current results of the Hostess brand. Where exactly is the underperformance coming from? Is it just the economy?
It's a confluence of things: internal execution issues and external market pressure. Externally, yes, the discretionary nature of sweet snacks means that inflation-weary consumers are probably pulling back on Twinkies more than they are pulling back on Jif peanut butter.
Makes sense.
But internally, SJM management has acknowledged they have underperformed in core areas. This includes insufficient execution and distribution, weak in-store merchandising, like they haven't been getting the secondary displays and end caps they anticipated, and critically competitive positioning. This has led to measurable market share loss in the sweet baked category to rivals.
So the integration hasn't been smooth.
No, they haven't achieved the synergy goals quickly enough, it seems.
So they have to demonstrate a concrete, viable turnaround plan immediately. Investors are waiting, impatiently I'd imagine, for proof they can stabilize this massive asset they just bought.
They do. They have a very clear three-pronged plan they'd articulated to address this underperformance. First, brand revitalization.
Okay, what does that mean?
They are refreshing the packaging and launching new, aggressive marketing campaigns specifically aimed at younger demographics. The goal here is to make the brands feel relevant again, to drive that critical impulse purchase behavior, and to recapture market share. They need Twinkies to feel like a modern, fun snack, not just a nostalgic relic from the past.
Okay, makes sense. The second prong sounds like classic cost optimization, which seems essential when margins are tight.
That is operational efficiency. They are optimizing the manufacturing and distribution network that came with Hostess, which was perhaps less efficient than SJM's. This includes a major tangible action, the closure of a manufacturing facility.
Closing a plant.
Right. This consolidation is projected to generate an estimated $30 million in annual cost savings. That's tangible margin enhancement that goes straight to the bottom line, validating the synergy thesis, even if it's coming a bit delayed.
And finally, leveraging the very core strength of SJM, that massive distribution moat we talked about earlier.
That's the third point. Distribution expansion.
Yeah.
They are strategically using SJM's existing enormous sales force and deep retailer relationships to push Hostess products into new away-from-home channels.
Like where?
This includes food service, vending machines, and mass merchant stores channels, where SJM has established strength but where Hostess traditionally had gaps. The idea is to quickly maximize the reach of the Hostess portfolio beyond just traditional grocery store shelves.
If they can't execute this turnaround plan successfully over the next year or so, what is the heightened risk? I mean, we've already seen the massive accounting loss. What else could happen?
The risk is immense. Failure to achieve the planned cost synergies, failure to stabilize sales volume, or worse, a further decline in profitability calls the company's largest ever acquisition into, well, existential question.
Right.
It would almost certainly lead to further financial risk, maybe potential additional impairment charges down the line, and definitely a loss of investor confidence in the management team's strategic vision. The financial success of the entire strategic pivot, the deleveraging, the dividend security we discussed, all hinges on Hostess stabilizing and starting to contribute positive cash flow as expected.
Okay, let's look at how management plans to allocate that impressive free cash flow engine we discussed, assuming Hostess stabilizes, and also how the market is currently viewing all this complexity, risk, and potential.
Well, the capital allocation priority is currently singular and, frankly, non-negotiable. It's entirely dictated by the enormous debt load incurred for the Hostess acquisition.
Which is, simply put, debt reduction. Pay down the debt.
Exactly. Deleveraging focus. The stated public goal is debt reduction above all else. They are targeting $500 million in annual debt paydown for the next 2 fiscal years.
$500 million a year.
$500 million a year. The ultimate target is to reach a more manageable leverage ratio of 3 times net debt to EBITDA by fiscal 2027. Everything else, pretty much, including discretionary spending and stock buybacks, takes a back seat to hitting this target. It's the responsible, necessary approach given the balance sheet leverage.
Does this intense focus on debt jeopardize their renowned dividend? SJM is famous for its commitment to returning cash to shareholders, isn't it?
That is a critical question for many income-focused investors, yes. SJM has increased its dividend for 28 consecutive years, making it a dividend aristocrat. And the dividend is definitely a cornerstone of their value proposition. It currently yields around 4%.
So is it safe?
Thanks to the robust free cash flow, that $875 million to $975 million guidance we talked about, the dividend appears highly secure. The cash generation is more than enough to cover the dividend payment while still allocating significant funds, that $500 million, to debt paydown.
Okay, good news for dividend investors.
However, while the dividend will likely be maintained, the pace of future annual increases will almost certainly moderate. The company will be channeling the bulk of its excess cash toward debt repayment rather than significantly increase shareholder distributions in the near term.
And the cost of this debt focus is the lack of stock buybacks, right? They're not buying back shares.
Absolutely. Stock repurchase activity has been minimal to non-existent since fiscal 2023. They have deliberately halted buybacks as a direct consequence of prioritizing deleveraging. This really highlights the cost of the Hostess acquisition. They chose immediate strategic growth and subsequent debt paydown over providing immediate stock support through buybacks.
Now, let's look at the price the market is assigning to SJM stock right now. Why does this stock appear somewhat discounted relative to its own history, especially given the strength of the core brands and that powerful FCF engine?
Yeah, when you look at the traditional valuation multiples, SJM is indeed trading at a discount. It suggests the market is still skeptical about the execution risk involved here.
For the numbers.
Their forward price-to-earnings ratio is approximately 11.5x, which is noticeably below their typical historical averages. More telling, perhaps, their enterprise value to EBITDA ratio, which is a better metric for a company with high debt, as EV includes that debt is about 10.5x, that's also below their 5-year average of around 11.2x.
So is the market pricing them like a troubled asset or just like a slow growth, maybe slightly risky one?
More cautious, I'd say, not troubled. If you compare SJM's multiples to similar mature, stable CPG companies, think General Mills, Campbell Soup, or Conagra, SJM is generally priced right in line with them. This suggests the market fully recognizes the stability of the core business and its cash-generative nature. However, it is not assigning a premium valuation yet.
Why not?
The current valuation reflects the immense execution risk associated with stabilizing Hostess and successfully managing that large debt load. The premium valuation, if it comes, will likely only return when they prove they can successfully integrate the acquisition and hit that crucial debt-to-EBITDA target by FY27.
So the robust 8.4% forward free cash flow yield is suggesting strong underlying value, but the current stock price discount is basically forcing management to prove they can handle the complexity they just bought.
That is the perfect summary. The potential value is definitely there, rooted in decades of brand building and reliable cash flow, but the high leverage introduces significant uncertainty that the market is currently, and probably fairly, pricing in. So, to synthesize the entire analysis for you, the Smucker Company is built on a remarkably powerful foundation, no question about that. They own iconic, dominant brands that reliably generate predictable and strong free cash flow.
Right, that FCF engine.
That FCF engine is their lifeline and their guarantee of survival, really. However, the creation of future shareholder value depends entirely on solving 2 major, complex, and intertwined issues. First, the complex operational turnaround of the $5.6 billion Hostess portfolio, and second, the systematic, committed deleveraging of that $8 billion net debt. It's fundamentally a race between the inherent strength of their legacy brands and the massive execution risks incurred during this huge strategic pivot.
And for you, the learner, trying to gain quick, thorough knowledge on this corporate strategy, the short-term success of SJM is really going to hinge on the continued, sustained momentum of
Yeah.
those fantastic organic growth platforms, Uncrustables and Café Bristolo.
Hmm.
Those two brands absolutely must be strong enough to offset the persistent volume pressures hitting their traditional categories due to inflation and, of course, the acute margin costs associated with that green coffee commodity crisis we discussed. That's the tightrope walk they're on.
They have the right vision, arguably pivot to growth, and they clearly have the cash flow to execute it. But they are fighting massive macroeconomic headwinds that are targeting their largest and most established cash cow segments, which just adds pressure to an already difficult integration with Hostess.
We'll leave you with a final, provocative thought that circles back to the financial risk.
Mm.
Due to the high leverage SJM took on for this pivot, their Altman Z-score, which is a common formula used by analysts to predict the likelihood of financial distress based on liquidity and debt metrics, stands currently at 1.34.
That's quite low.
Historically, a score below 3 suggests an increased risk of financial instability or distress. This creates a fascinating question for you to ponder. Can decades of deep brand loyalty, the kind that built the Smucker's legacy, successfully shield the company from the very real short-term financial volatility inherent in such a massive, debt-fueled, and clearly challenging acquisition? It's a truly sweet, salty, and incredibly complicated bet they've placed.
A very complicated bet indeed, and we thank you for diving deep with us today.